Many investors chase big-name companies or high-dividend stocks, thinking they're the safest bet. But there's a better way, focusing on earnings growth. I'm Brian Rezny from Rezny Wealth Management, and today I'm excited to share a powerful strategy for growing your wealth and securing your retirement. In this video, I'll explain why earnings growth is a superior opportunity for building a portfolio that not only grows your wealth, but also provides increasing income to outpace inflation. Let's dive in. When building a portfolio, it's tempting to gravitate toward high-dividend stocks. They seem reliable, big-name companies paying consistent dividends, promising steady income. But here's the catch. High-dividend stocks can often underperform over the long term. Why? Many companies with high dividends are mature businesses with limited growth potential. Their earnings growth is flat or declining, and they rely on dividends to attract investors. But if their earnings don't grow, their stock price often stagnates, limiting your total return. Second, dividends aren't guaranteed. Companies facing financial trouble may cut or eliminate dividends, leaving investors with less income than expected. Finally, dividends alone rarely keep up with inflation. If your goal is a retirement income that grows over time, high dividend stocks can fall short. Instead, we need to focus on companies that are growing their earnings, the engine that drives both stock price appreciation and sustainable income. What makes earnings growth so powerful? Earnings are the profits a company generates, and companies with strong, consistent earnings growth are typically innovators or leaders in their industries. Here's why they're a better bet. Stock price appreciation. Companies with growing earnings tend to see their stock prices rise over time. This capital appreciation can significantly boost your portfolio's value, far outpacing the returns from dividends alone. Future income potential. Earnings growth often leads to dividend growth or even the introduction of dividends. Companies like Apple, which started as a growth stock with no dividend, now pay a growing dividend because of their robust earnings. Inflation protection. Earnings growth drives increasing cash flows, which can translate into rising dividends or reinvestment opportunities. This helps your income keep pace with or exceed inflation, ensuring your retirement lifestyle is secure. By focusing on companies with strong earnings growth, you're investing in businesses that are thriving, adapting, and positioned for long-term success, not just resting on their brand name. Now, let's compare. High dividend stocks like utilities or telecoms often offer yields of 4 to 6%, but have limited earnings growth. Their stock prices may barely budge, and their dividends may not grow fast enough to combat inflation. Over 20 years, your real purchasing power could erode. Contrast that with growth stocks, companies with moderate or no dividends but strong earnings growth, like tech or healthcare innovators. These companies reinvest profits to fuel expansion, driving stock prices higher. Over time, their total return, stock price growth plus any dividends, often far exceeds that of high dividend stocks. Even if they don't pay dividends now, many growth companies start paying them as they mature, giving you the best of both worlds: capital gains and growing income. So, how do you apply this to your portfolio? At Rezny Wealth Management, we believe in a balanced approach that prioritizes earnings growth. Here's how. Seek companies with strong earnings. Trends. Look for businesses with a track record of growing earnings year over year, ideally in industries with long-term potential like technology, healthcare, or renewable energy. Don't ignore dividends entirely. Include companies with moderate dividends that are growing, as this signals healthy earnings and a commitment to shareholders. Diversify for stability. Combine growth stocks with other assets to manage risk, ensuring your portfolio can weather market ups and downs. Think long-term. Earnings growth compounds over time, so stay patient. Your portfolio will grow and your income will rise, giving you the retirement you deserve. Focusing on earnings growth isn't just about picking stocks. It's about building a portfolio that grows your wealth and delivers increasing income to secure your retirement. Don't settle for big-name companies or high dividends that may underperform. Instead, invest in the power of earnings growth. At Rezny Wealth Management, we're here to help you build a portfolio tailored to your goals. Contact us today for a complimentary consultation, and let's start growing your financial future together. I'm Brian Rezny. Thanks for watching, and I'll see you in the next video.